Hello everyone. In this particular recording, we're going to take a look at Chapter 3, and the main topic in Chapter 3 is CVP analysis. CVP is an acronym for Cost Volume Profit Analysis. Now this is something that's very important in the planning tools for a cost accountant. Basically what it does is CVP analysis measures the relationships between all of your costs and your profits. So we're going to use different formulas to try to fit in equations to figure out how CVP analysis can help us in our planning tool. You are also going to see in our planning, we do a lot of what-if scenarios. What if we did an advertising budget? What if we decided to enter into a new market and expand operations? What if we did this? What if we did that? What if we contracted? What if we added a new product line? What if we took away a product line? Well, anyway, the tools that you learn in this chapter, CVP analysis, will help us try to answer some of those questions. Okay, so as a summary of what we talked about in a previous discussion, there is a 5-step decision-making process tool that is used in managerial accounting. The first step, of course, is to identify the problem. And we can't do anything about problem solving unless we know what the actual problem is. So that's step 1. Once we've identified the problem, then our next step is to obtain as much information as possible to try to tackle that problem and answer that problem. After we've obtained all the information, we can then start to make predictions about the future. And I bet you all know people that stop right there. They know what a problem is, they kind of gather some facts, and then they make a prediction of what's going to happen, and they end it right there. They don't do any further analysis. I'm talking about not only accounting situations, but life situations. I bet you can all think of someone in your life right now that is just very quick with making decisions without doing a lot of analysis. And so they basically stop at step 3. But we're not like that. Obviously, what we need to do after we make predictions, we have to test our predictions. And we will do that by doing some analysis. And in this particular chapter, the analysis that is important and that we're going to learn is the CVP, or the cost volume profit analysis. And once we've kind of seen the CVP analysis, then we can make our decisions. We can implement the decision, but we don't stop there. Remember, in accounting, it's a continuous cycle. So yes, we implement the decision, but we have to evaluate the results of that decision. And if we've made a mistake, if we find that we make a mistake, we can always go and revisit that situation and implement a newer or a different alternative decision. It's a constant learning process. Okay, so here are some assumptions we need to make before we get into the details of CVP analysis. Okay, the first assumption is that when we change production and or sales volume, these are the 2 root causes for cost and revenue changes. If we change sales volume, we're going to change our revenue numbers. If we change production level, we are going to change our costs. And remember, costs are broken down into 2 groups, fixed and variable. Actually, there's a third group called mixed, but mixed costs are basically partly fixed and partly variable. And remember, fixed costs are the same in total regardless of activity. Variable costs are the same per unit, but they will increase as activity increases and vice versa. Revenues and costs, because of these relationships between how the costs work with sales volume, we can actually graph it out. So there will be a graphic that will be a picture, if you will, of our revenue and cost structure. Selling prices, variable cost per units, fixed costs, we know them and they're going to remain constant. Obviously, if sales prices change, if variable costs per unit change, if fixed costs and total change, the CVP analysis is basically not going to work. So this has to be an assumption. We're working within our relevant range, and these three items are going to remain the same as we move through it. Okay, we are going to analyze a single product at a time. Obviously, if you have a manufacturing plant and you are producing multiple products, every product has their own CVP analysis. Now, certainly, if you've got a certain mix of products in your production plant, you can do an overall CVP analysis for that particular product mix. But just keep in mind that if your product mix changes, meaning we're selling more of product A and less of product B, and they had different CVP analysis individually, the overall CVP analysis will also change. For CVP analysis, we are going to ignore the time value of money. The time value of money we will study later on in the semester. That comes into play, especially when we're making decisions about future revenue streams and future cost streams, future cash flows, whether they're cash inflows or cash outflows. That's something we'll look at a little closer later on in the semester. Some formulas you should be familiar with. And the first item that is important is called contribution margin. This is new concept. Usually up to this point in the course, you're only familiar with what an accountant would call gross margin. And remember, gross margin are basically your sales less your cost of goods sold. But when we take a look at CVP analysis, it's better to look at what we call contribution margin instead of gross margin. And the contribution margin is going to be the total revenue minus all the variable costs. Now keep in mind, variable costs could be both manufacturing costs as well as non-manufacturing costs. So we certainly have to be mindful. Variable costs are not all manufacturing. Okay, contribution margin per unit. Well, it's basically the contribution margin in total dollars divided by the number of units sold. That will give us our contribution margin per unit. The operating income is going to be the contribution margin less all of the fixed costs. And remember, all of our costs are either fixed or variable. So after contribution margin, which remember, that formula considers the variable costs, once we subtract out the fixed cost from the contribution margin, that is our operating income. And of course, if we ever wanted to know what our contribution margin ratio is, that would be the contribution margin divided by the revenue. So this is a very important slide. It kind of gives us our basic equations that we're going to need in our analysis. Okay, let me see. Okay, some equations. So with everything laid out, like I said, the contribution margin is your revenue minus your variable costs. So if you take a look at the entire equation, it's up here. I'm kind of circling it with my cursor. Let me move back so we can see it. Here it is. The equation will be revenue minus variable costs. Remember, revenue minus variable costs gives you a subtotal called contribution margin. And then from there, if we subtract out fixed costs, we get operating income. Now, if you wanted to break that down a little bit further, and I know this gets a little cumbersome and a little confusing with all the acronyms here, but just follow it through. So the contribution margin method, remember, the contribution margin is revenue minus variable costs. So if we take SP stands for selling price, times the quantity. Think about that logically for a minute. Selling price times quantity. That gives you the revenue. Minus VC is variable cost times quantity. That gives us total variable costs. So total revenue minus total variable costs, that will give you the contribution margin. Minus FC stands for fixed costs. So if we subtract out fixed costs from our contribution margin, we get OI. OI stands for operating income. So really we're just kind of breaking down a little further what the revenue is, what the variable costs are. All right, now let's put some numbers to it. We have a company called Tiny's Cabinets. Tiny sells his cabinets for $600 each. After analysis, his cost accountant tells him that his variable costs per cabinet are $350 each. And Tiny knows that his annual fixed costs are $20,000 in total. So the first what if question of many in this chapter. If Tiny sells 100 cabinets, what's going to be his operating income? Well, once again, if we just throw all the numbers we know into the formula, we can figure this out. So here is the solution. You can see it kind of at the midway point of your slide. The selling price per cabinet is $600 times quantity. We know the quantity is 100. So 600 times 100 minus the variable cost. The variable costs we said were $350 each times 100. So total revenue, which is $60,000, minus total variable costs. When you do the math, that's $35,000. That gives you contribution margin. And that would be, what is that? That would be $25,000. And if we take the $25,000 minus our fixed costs, which we know are $20,000, that gives you operating income, $5,000. So really, this is just kind of figuring out if we knew how many cabinets we typically sell or we're budgeting to sell, we know our sales price, we know our variable cost per unit, we know our fixed costs, we can predict our operating income. And guys, I can't even stress how important this is for especially a new company. Budgeting and especially knowing these tools, how to do these what-if scenarios, understanding CVP analysis. This is going to really improve your opportunity to make it, to be successful. And it all boils down to this. This is the key to succeeding, knowing how your costs behave. I can't tell you how many entrepreneurs, how many new companies start and they fail. And a lot of times they fail because they don't know how their costs behave. If you know how your costs behave, and once again, they are either variable or they're fixed, you are better able to budget, you are better able to forecast the future. And you have a goal in mind. It's easier for you to reach the goal when you know what the goal is. Okay, my rant is over. Let's move on. Now that we understand the formula for operating income, we can actually use that formula to come up with a break-even point. And basically, in summary, a break-even point is when operating income is zero. That's basically what the break-even point is. Your total revenue equals your total costs. And as a new company, you want to be able to get to the break-even point quickly. And if you can get to the break-even point quickly, you have a good chance of success. So you can see the formula here on this page. It's the same formula we've been looking at. We are just going to default the operating income on the right side of the equation to be 0. If we set this to 0, and we've got our formula here, our equation, I should say, we know we're going to figure out how many cabinets we need to sell to break even. So let's take a look at it. The break-even point when total revenue minus total cost is 0. Okay, so we put 0 here for operating income. We know everything else. We know our selling price is 600 times Q. Remember, Q is the quantity. We're trying to figure out what the Q is at the break-even point. So we're going to leave it blank for now. Minus 350, which is the variable cost times Q. Minus your fixed cost, we know are $20,000. So if we do a little high school algebra, and I'm not here to reteach you high school algebra, but if we solve for Q in this formula, 600 minus 350, that's 250Q. and we'll put the 20,000 on the other side of the equation. Solve for Q. Q is 80. We need to sell 80 cabinets to break even. Now think about how powerful that is for Tiny. Tiny's Cabinets, the company. If they know before the year starts that I know I got to sell at least 80 cabinets to break even, that is it's much better than them saying in the beginning of the year, I have no idea how many cabinets we need to sell to break even or make a profit, and they just kind of go with the flow. Really not the best way to run a business. Okay, what I have showed you is the equation method, but there are other methods to use as well, and they're really called formula methods. And you can see down at the bottom part of this slide, there are two formulas. If we're trying to find the break-even point in revenues, the formula to use will be fixed costs divided by the contribution margin percentage. If we're trying to find the break-even point in units, like we did up here, where we said 80 units is the break-even point, instead of using this long equation method, we can use this formula method, which is fixed costs divided by contribution margin per unit. Either way, it works. And let's practice our formula. So if we know our, our contribution margin per unit is $600 selling price minus variable cost of $350. Your contribution margin per unit is $250. So if we take the fixed costs of $20,000 divided by the contribution margin per unit of $250, guess what? You still get the 80. All right, so the formula method works just as well as the equation method. If you wanted to figure out what is the break-even point in revenues, once again, it'll be the fixed costs, but it'll be, instead of divided by the contribution margin per unit, it's going to be the contribution margin percentage. The contribution margin percentage is right here. I'm circling it. It's your variable costs. Your contribution margin per unit divided by your selling price. That gives you the contribution margin percentage. Take that percentage. That is the numerator. The denominator. The numerator is your fixed costs. You'll get your break-even point. I know I need to sell almost $48,000 in cabinets, and I know when I get there, that is the break-even point. So you can see how powerful knowing these equations and formulas are. You can do a lot of what-if scenarios. What is it going to take to break even in units, in revenue? You could take that one step further. You can actually do target profit analysis. And basically, the target profit is when we replace the break-even point of 0 with our target profit. Let's say our goal is to make a $30,000 profit or operating income. So what we are going to do in our equation, we're just going to replace the 0 with $30,000. Or if we were going to use the formula, what we would do is follows. In the numerator, instead of it just being fixed costs, it's going to be fixed costs plus the target income, which in this case is fixed cost of 20 plus my target profit of 30,000. There's your new numerator. Divided by the same denominator, contribution margin per unit. And when you solve for Q, you know you would need to sell 200 cabinets if we want to make a $30,000 operating income. So hopefully by now you can see how powerful these formulas and these equations are. Extremely, extremely powerful. Okay, here's a graph. I'm not going to go through the graph in details, but you can see on the y-axis we have the income and the expenses, of course, and on the x-axis we have the number of units sold. And you will see that the break-even point is right when the operating income and the expense line is 0, and our graph shows the line going upwards. All right, when we sell 0 units, our profit is negative. That makes sense, right? Because we have fixed costs. But obviously, as we sell more and more and more and more and more, that is the break-even point. And certainly when we start to sell even more than the break-even point, this area here is the operating income. The operating income is getting larger and larger and larger as we sell more units. So you can actually graph this out. This is called a profit volume graph. Okay, one more topic on the CVP before we move on to some other analyses, and that is in respect with income taxes. Now, some of you may have realized it, but in the last few slides when I've done break-even analysis and target profit analysis, some of you may have said to yourself, Professor, you totally ignored income taxes. And yeah, I did. And I did on purpose because I wanted you to kind of get comfortable with the formulas first before we went into understanding that taxes play a part in this as well. And so we are going to calculate our, instead of target operating income, target net income. And what is the difference, the main difference between operating income and net income? The main difference is our taxes. So what we're going to do is as follows. We can convert operating income into net income. All right, and so we're going to do that by using this formula here. Net income is the operating income times 1 minus your tax rate, your percentage rate. Let's say the tax rate is 35%. So 1 minus 35%, that would be 65%. If we take the 65% times operating income, boom, there's your net income. Okay, and using it in the CVP equation, we will take net income divided by 1 minus the tax rate. Let's take a look. Tiny's cabinets. Tiny still wants to earn $30,000 net income this time instead of operating income. So what are we going to do? Let's take a look. Using the equation, like we said, what is the quantity that we need to reach in order to make net income of $30,000? Okay, your numerator is going to be your fixed costs, which we know are $20,000, plus the target operating income. What is the target operating income? It's $30,000, but we are now going to divide that by 1 minus the tax rate, which we know to be 35%. 1 minus 35%, that's 65%. Divided by, and there's your denominator in the equation, $250, which is your contribution margin per unit. And when we do the math, it works out to 265. I need to sell 265 cabinets in order to earn a $30,000 net income. And when you think about it, net income is truly the bottom line of the income statement. And a lot of times the analysis is not so much on the operating income, but more so, I would think more companies would want to figure out their net income, target net income instead of their operating income. So that's when the tax rate comes in. Okay, now let's go through some what if scenarios. What if, all right, we know Tiny's cabinets, they typically sell 100 cabinets. And we saw earlier, you may have remembered in this presentation, that when we sell 100 units, selling price was 60 times 100, revenues are 60,000, variable costs are 350 times 100 or 35,000, fixed costs are 20,000, and we had operating income of $5,000. Now, what if Tiny spent $5,000 on advertising? And sales would increase based on our analysis. If we spent $5,000 on an advertising campaign, I think sales would increase by 10%. So some people would say, yeah, revenues would grow from $60,000 and they would grow by 10%. So 60,000 plus an additional 10% or 6,000. New sales, new revenue is 66,000. You might look at that and say, hey, $6,000 in extra revenue to spend $5,000 on advertising, you might think to yourself, I'm in. But you're a little bit too quick for the decision. You have to analyze the entire, what that $5,000 does on everything, not just the revenues. The variable costs are $350 per unit. $350, how much are we selling now? No longer 100 units. We're now selling 110. $350 times 110. Your new variable costs are $38,500. And your fixed costs are no longer $20,000. Remember, we have this new $5,000 advertising budget. So our new advertising brings our fixed cost to $20,000, or from $20,000 to $25,000. Now when you do the math, revenues minus variable costs gives you contribution margin. From there, subtract out fixed costs gives you operating income. Now what would you rather have as operating income? $5,000 or $2,500? You are all saying I'd rather have $5,000. So guess what? It's not worth advertising. It actually makes it worse if we do advertising. The advertising budget in cost is too much. Okay, so basically that is what that basically slide said. Okay, couple of other concepts, couple of analyses before we wrap this up. So like we were saying, CVP provides a structure to answer a lot of what-if scenarios. What if we sold 100 units? What is the break-even point? What if I want to target profit? What if I want to break even? What if I want to advertise for $5,000? What if, what if, what if, what if? So obviously the what-if scenarios are all answered by CVP, and that is very important. Couple of other concepts which help us in our budgeting. And the first concept is called margin of safety. Basically, in a nutshell, the margin of safety is how far away we are from the break-even point. So if we are in the budgeting stage, the margin of safety is going to be the budgeted sales minus the break-even sales. Let that sink in for a minute. It's the budgeted sales minus the break-even sales. So if we are very successful, what's going on? We are moving further and further away from the break-even point. So when you are more successful, your margin of safety is going to be larger. The larger your margin of safety is, the safer we are, meaning the further we are away from the break-even point. Okay? The margin of safety ratio would simply be the margin of safety divided by the budgeted sales. And once again, we want our margin of safety to be high. We also want our margin of safety ratio to be high. Okay, another concept, operating leverage. And take a look at the title of this particular slide. This gives you the formula for operating leverage. It equals the contribution margin divided by the operating income. The contribution margin divided by the operating income. And think about our formula. What is the difference between contribution margin and operating income? The only difference between those two is the fixed costs. Remember, you've got in summary, at the top, you've got your revenue minus your variable costs. That gives you your contribution margin. From there, you will subtract out your fixed costs, and that will give you your operating income. So contribution margin divided by the operating income. Once again, the only difference between those two are the fixed costs. And so you will find that organizations with a high proportion of their costs as fixed, they are going to have a high operating leverage. Okay? Because that means the contribution margin is going to be much greater than the operating income. When fixed costs are relatively small, what does the operating leverage turn into? Think about it percentage-wise. It'll be a lot smaller, wouldn't it be? Because that would mean the contribution margin and the operating leverage are relatively close to one another. So with high fixed costs, we have a high operating leverage. And if we have a high operating leverage, that means increases in sales are going to give us a much greater impact on our operating income. For example, let's take a look at this. As an example, if our operating leverage is 1.67, and this I just picked this out of the air. 1.67 is the operating leverage. If I increase sales by 50%, how would you know what happens to operating income? It's simply going to be the sales increase times the operating leverage. And like I said, if we had a high proportion of our costs being fixed, we're going to have a higher operating leverage. Let's say this 1.67 was 3.0 and its sales increased by 50%. That means operating income, in a case where operating leverage was 3.0, that means my operating income would increase 50% times 3, or 150%. So you can see when most of our costs are fixed, all right, increases in sales have a greater impact, either way, up or down, on operating income. This is called basically the margin of safety analysis, the operating leverage analysis. This is called sensitivity analysis, how sensitive our numbers are to changes. Okay, and like I said earlier, your sales mix itself will have a great impact on the CVP analysis. That's why it's pretty important for companies to analyze their CVP on a product-by-product basis. Because once you have changed the mix of products that you're selling, it's going to change the overall CVP for the entire company. And it changes way too much for analysis. And also wanted to say, CVP, I know we're concentrating so far in this class on manufacturing companies where we are producing a product with the materials, the labor, and the overhead. But CVP analysis could also be used for service companies and nonprofit companies and governments. All right, certainly it could be used for others as well. So just keep that in mind. Remember, all companies have fixed costs and variable costs. And so as long as we have fixed costs and variable costs, CVP analysis will work for that particular company. And I just want to wrap up this chapter by talking about contribution margin and comparing it to gross margin. Remember from your Principles 1 studies, gross margin is simply revenue minus cost of goods sold. We also discussed that in the prior chapter as a refresher. In this chapter, I've introduced the concept of contribution margin, which is revenue minus all of the variable costs. This is very, very important when it comes to analysis. I think manufacturing companies like to use the contribution margin format income statement internally, but externally, of course, you still have to use the gross margin type income statement. That's required by GAAP. But certainly the contribution margin format is better for internal analysis purposes. Okay, last example. This will show you the difference between the contribution format and the gross margin format. We still have Tiny's cabinets. Our selling price is still $600, but here's the difference. This is what I want to show you. We produced 100, but in the prior examples in this chapter, we not only produced 100 cabinets, but we also sold 100 cabinets. I'm going to throw a little curveball at you here. We produced 100 cabinets, but look how many we sold. How many? I'm circling it. Only 90. That means how many cabinets are in ending inventory? Well, if we produced 100, let's assume there was no beginning inventory. It's a brand new company. If we produced 100, but we only sold 90, that means we have 10 cabinets in our ending inventory. Please keep that in your mind. 10 cabinets are in the ending inventory. Selling price is still $600 each. The variable costs are $350 each. Our fixed costs are still $20,000. Now, out of the $20,000 in fixed costs, remember, some of them are manufacturing costs and some of them are non-manufacturing. So out of the $20,000, only $15,000 is actually part of the manufacturing fixed cost. On the left-hand side, we're going to figure out the net income or operating income using the contribution format. And over on the right-hand side, we're going to figure out operating income using the gross margin format. Sales. You're going to see in both, sales are going to be the same, $54,000. Very simple. Sales are the number of units sold, which is 90 times the selling price. 90 times 600 is 54,000. That would be the same whether it's contribution margin or gross margin. Okay, from the contribution margin, after sales, remember we subtract out variable costs. The variable costs are going to be the number of units sold times the variable cost per unit. 90 times 350, or 31,500. We will subtract that from sales, and we get contribution margin. From the contribution margin, we will subtract out all of our fixed costs, which remember are $20,000. That's the $15,000 manufacturing fixed costs and the $5,000 non-manufacturing. Basically the general administrative expenses, if you will. All right, the 15 and the 5 is the 20. Subtract it from the 22,500. You get operating income of $2,500. Now let's compare the gross margin method, which is required by GAAP. I can't stress that enough. The gross margin method is required by GAAP. So we start off with the same sales number, 54,000. And remember, from the sales, we're going to subtract out our cost of goods sold. Our cost of goods sold is going to capture all of our manufacturing costs, whether they are variable or fixed. And we said our variable cost per unit are $350. All right. And our fixed cost per unit, what is that? Remember, our fixed manufacturing costs were $15,000. And how many cabinets did we make? 100. 15,000 divided by 100. That's 150. So if you take the $350 plus the $150, you get $500. $500 times the number of units sold, which is 90. 500 times 90 is 45,000. Subtract that from sales, you get gross margin. And remember, from the gross margin, we're going to subtract out our general administrative expenses, which we said were only $5,000. Remember, the fixed costs are $20,000 in total. $15,000 was manufacturing. That means the remainder, $5,000, was for non-manufacturing. Operating income is $4,000. So some of you are saying to yourself, how in the world, this is the same exact information, the same exact company, the same exact number of units produced, the same exact number of units sold, how in the world can operating income be $4,000 using gross margin, but only $2,500 using the contribution margin? Why do we have a $1,500 difference? Now, some of you may have already figured this out. As I was talking, you realized where the $1,500 is. Remember what I said to you. With the gross margin method, we have to account for our cost of goods sold only for the number of units that we actually sold, not produced. How many did we sell? 90. How many did we produce? 100. Remember what I said to you. There are 10 cabinets in the ending inventory. And guess what? The fixed cost per unit, remember we said was 150? 150 times the 10 is $1,500. the $1,500 is sitting on the balance sheet in the inventory account, the finished goods inventory account. It's going to remain in the finished goods ending inventory account on the balance sheet until we sell it. But the contribution margin method, all of the fixed manufacturing costs are expensed when incurred. There is a difference in accounting. And the gross margin, you can't. You have to keep all of the cost with the inventory until it sells. All right, it gets absorbed into the inventory. A lot of times the gross margin method, a lot of times you will hear companies call that absorption costing, because we are absorbing the costs into the inventory. All right, and but with the contribution method, as soon as we spend the fixed costs, it gets expensed. Doesn't matter if the units get sold or not. So that is the difference in this case. All right, so a lot of information, CVP analysis, this is very important. And from there, we can do some sensitivity analysis. Hopefully, you're starting to understand how all of the revenues and the costs relate with one another. And we can do various analyses on that.